Welcome to today's webinar on transitioning from a sole proprietorship to a partnership in Canada. My name is Nishanthi Nehru. I would like to tell you a little bit about myself. I have extensive legal experience in family law, civil litigation, criminal court. I've worked in various legal roles over the years, helping clients navigate complex legal challenges. I also spent 8 years in court services working closely with justices, lawyers, and legal staff. This experience has given me a deep understanding of procedural and statutory obligations, which is invaluable in my practice. In this session, we'll cover the key considerations, legal requirements, financial implications, and tax consequences of forming a partnership. This is a significant step for a business owner looking to expand, share responsibility, and potentially reduce financial risk. By the end of this webinar, you will have a clear roadmap to successfully transitioning from a sole proprietorship to a partnership. So, what is a sole proprietorship? As you are aware, if you have been following my webinars, I have discussed sole proprietorship in some detail over the past few webinars that we've had in the beginning. A sole proprietorship is the simplest business structure in Canada. The business owner has complete autonomy over decisions and operations and profits. However, one of the biggest risks of running a sole proprietorship is unlimited liability. This means that if the business incurs a debt or legal troubles, you're personally responsible. Your assets will become available to those individuals for the lawsuit, including your home and savings, may be at risk. They will all be at risk. While this structure offers simplicity and ease of step, it does not provide any legal distinction between you and your business. Now we're going to what is a partnership. A partnership is a business structure where two or more individuals share ownership. Each partner contributes resources such as capital, skills, or expertise, and in return shares in the profits and losses of the business. The key to a successful partnership is a well-drafted agreement that outlines roles and financial responsibilities, conflict resolution strategies. Unlike a sole proprietorship, a partnership distributes risks and decision-making authority among multiple individuals, making it preferred choice for business looking to expand their operations. Now we're going to the next slide, where if you see, there are different types of partnerships. So what type of partnerships exist? There's a general partnership, and then there is a limited partnership. There's also limited liability partnership. So these are three distinct forms of partnerships. There are primarily three types of partnerships in Canada, each offering different levels of liability protection and management roles. A general partnership involves shared responsibilities and liabilities among partners. A limited partnership includes both general and limited partners, where limited partners are only liable up to their investment amount. And that means that the limited partner, however amount of money they contribute, that is the only amount that they will be liable for. Lastly, a limited liability partnership is primarily used by professionals such as lawyers and accountants and provides personal liability protection to partners. Understanding these structures is crucial when deciding which model best suits your businesses. So please make sure that you review these three different type of partnerships, which I will go through in the next few slides and address before you actually decide which partnerships are suitable for you. A general partner. So let's go talk about general partnerships. What is a general partnership? How do you define it? A general partnership is mostly straightforward from a partnership perspective. All partnerships share equal responsibility for the business's operations, profits, and debts and liabilities. While this structure allows for ease of setup and shared decision making, it also means that each partner is personally liable for the obligations of the business. This means that if one partner makes a poor financial decision, they can actually create liability on all the partners. So this means that any decision made by any of the individual partners can create liability on all of the partners, not only one partner, but all of the individual partners. A well-drafted partnership agreement can help set expectations and prevent disputes as well as liabilities. It could also render the individual partners a protection against any kind of disputes or liabilities that will incur in the future. So let's go to the next slide. Let's discuss limited partnerships. What is a limited partnership? A limited partnership consists of at least one general partner who manages the business and assumes full liability, and one or more limited partners who provides financial contributions but have no involvement in the daily operations. Limited partners enjoy protection from liability beyond their investments, making this an attractive option for investors who want to support a business without being actively involved in its management. But remember this, you could have multiple general partners who make decisions. However, the limited partners cannot make decisions. They are not permitted to. That is the concept of the limited partnership. It restricts these individuals from any kind of decision making or authoritative actions. They should be they are able to participate in the business but not in an active management role, and they are not allowed to bind any organizations under the partnership agreement as they are limited partners. But if they do decide to do that, they lose their limited liability, so they become managing partners at that point. Remember this information because it is important in a limited liability partnership agreement. Let's go to the next slide. So what is a limited liability partnership? So this concept of a limited liability partnership is important because a limited liability partnership is specifically designated for professional firms such as law practices and accounting firms. Unlike a general partnership, an LLP protects individual partners from being personally liable for the professional negligence or misconduct of their colleagues. However, partners remain responsible for their own actions. Due to these liability protections, LLPs are subject to strict regulations from the professional governing body. So this would be more for organizations with professional restrictions and governing bodies who regulate them. If you are a member of these organizations, please make sure to discuss or look into your regulatory body's requirements and responsibilities to operate these kind of LLPs. And they actually create limited liability, but sometimes you could still, if it is a business decision, there may be requirement that you take responsibility for the business partnership. So There are different aspects of it, which is more complicated and should be discussed with a lawyer or a with with a lawyer to be able to understand the differences. Okay, let's go to the next slide. Legal requirements for registering a partnership. To legally establish a partnership in Canada, you must register your business with the appropriate provincial or federal authorities. Depending on your business or your type of, like if you want to conduct your business in Ontario, or if you wanted to conduct your business on a Canadian scale, a wide scale, make sure you look at the statutes and regulations that are actually implied in these federal and provincial requirements. And depending on the province, this may require filing forms such as Form 5 under the Business Names Act. Keep in mind that business registrations must be renewed every 5 years. And additionally, regulations may apply depending on your industry. So always check the statutory or regulatory body, statutory requirements under the required statutes. Okay, so let's go to the next slide. Drafting a partnership agreement. A well-written partnership agreement prevents disputes and ensures smooth operations. It should clearly define roles, profit-sharing arrangements, decision-making authority, and dispute resolution processes. These are important. Remember that dispute resolution processes are very important for any kind of legal actions that may arise out of a partnership that decides to dissolve, or a partnership that encounters conflicts within the partnership. This agreement should also include exit strategies. Sorry, I can't say that word now. Exit strategies. In case one of the partners decides to leave or the partnership dissolves, even in cases where there is a death of a partner. How would you decide to deal with it? These are important things to consider in your partnership agreement. So make sure you consult with a lawyer. Depending on the circumstances of your industry, you might want to make sure that your regulatory requirements are also met, and that you have reviewed the Partnership Act, which I will discuss in a bit, about why it is important to make sure that your contract includes these type of issues. Let's go to the next slide. When transitioning to a partnership, financial clarity is key. You need to determine each partner's financial contributions, open joint bank accounts, and establishing bookkeeping procedures. It's also important to plan how profits, expenses, and debts will be handled to avoid conflicts. This is important and essential for your business operations, not so much for if you're doing a service requirement, but it does require for an entrepreneur to know these aspects within a partnership, how to discern where the profits have to go, where the expenses will have to go, because a partnership, although you're in a partnership and you have an agreement, the partnership itself is individually owned. So it's a sort of a tricky measure to do your taxes under the partnership, which we'll discuss in a next few slides. Let's go first to the liabilities. Those are the things that everybody's concerned about, because liabilities, they don't occur in one issue. Like if you had owned a business and you had a partnership and someone slips and falls on your property, now you have a liability for a lawsuit for injury. See, these are liabilities that occur on a regular basis, or maybe irregular basis, depending on how you maintain your property. And these are things that even an entrepreneur should consider, no matter what type of business you own. So think about all of the requirements for liabilities. Liabilities will differ depending on the partnership type as well. So if you have a general partnership and you have a limited partnership, they will have different type of liabilities. Even in a limited liability partnership, you will be limited in a professional limited liability partnership. You'll be limited to the liability to you as an individual, even if you have multiple partners. So these are all things to be considered within that. In a general partnership, all partners share liability equally. In a limited partnership, limited partners are only liable up to their investment. So any amount of investment that they put into the partnership, that is what they are liable for. And beyond that, it will end up going to the general partners. Even in a lawsuit, that may be the incurred decision. But remember, you really have to determine each step by talking to a lawyer, because case law is very relevant in all of these liability issues. In a LLP, partners are protected from liability for each other's mistakes, from each other's mistakes. So that means that each individual has to be responsible for their own mistakes. However, if it's a business decision, there may be changes and issues that you may encounter even in a limited liability partnership, where all the partners may become responsible. So make sure to check with a lawyer, or if you're in a limited liability partnership and you're an accountant or a lawyer, then you will already know that you need to check case law to determine what the steps are, whether it'll be more impacting your personal liability or the whole business liability. To further protect your business, consider getting liability insurance. That is actually really helpful in the fact that it'll actually assist you. And if you need to hire a lawyer, liability insurance may cover that aspect of your legal fees, which will, divert a lot of funds. Legal fees are expensive. So there are many considerations you should make when you're making these partnership agreements. Let's go to the next slide. So taxes. Everybody knows taxes are not fun, and taxes, we have to still do them. Every partnership is required to do taxes. However, partnerships do not pay taxes directly. Instead, each partner reports their shares of the business income on their personal tax returns. A statement of partnership income will be filed with Canada Revenue Agency to actually let Canada Revenue Agency know that you are in a partnership. However, let's say you have a corporation that's in the partnership. You can definitely have partnerships with corporations. Multiple corporations can create their own partnerships. It really depends. So remember that the corporations have a different tax structure compared to that of a partnership. So the corporation may be required to file a specific type of tax. So in this instance, make sure that your corporate taxes are identified, and how you are filing them and when you are filing them should be discussed with your accountants or any professional accountant that you hire, or your bookkeeper. That's what I meant to say. Next slide. So transitioning from sole proprietorship to partnership. To make the transition, update your business registration, notify the Canada Revenue Agency of structural changes, and adjust your financial records accordingly. Additionally, inform clients, suppliers, and financial institutions about the change. Make sure you also get legal advice on any kind of formation of this structure, especially if you're doing an agreement. The agreement has to adhere to a lot of requirements by statute. So make sure that you obtain that legal advice before you go into a partnership. These are essentials for any kind of partnership, as it creates liabilities on you, and you don't want to lose that protection from the liabilities. So make sure to consult with a lawyer. Let's go to the next slide. So, industry-specific regulations. Certain industries require special licenses and compliance for partnerships. Professional fields like law, medicine, accounting must register with their respective regulatory bodies. Be sure to research industry-specific regulations before setting up your partnership. This means each regulatory body that you fall under, if you're a professional who is within, let's say, the architect field, or if you're a professional in the medicine field, you have your own regulatory bodies that have professional conduct requirements, that have specific service requirements. So make sure you know that whether you're creating that partnership, that you have implemented the requirements for all parties to follow the regulatory body, the professional governing body's requirements. Those are essential in making sure that your partnership actually is following all the requirements. Let's go to the next slide. Common challenges in partnerships. Partnerships face common challenges such as disagreements over management, financial disputes, and unequal workload distribution. These can be mitigated by a well-structured partnership agreement and open communication. This is important because if you do not put the requirements for an open communication, like not open communication, but you want to have implemented a specific strategy in your agreement that indicates that there should be either mediation or arbitration if you have disputes between the parties, so that you're not going to external bodies or you're not going straight to court to dispute a matter when it could be resolved within the organization or by a third party who is a mediary, and they would be able to review the issues and maybe negotiate these concerns that are within that dispute. These are the things that we should consider within the partnership because they make the partnership flow easier, and any kind of disputes will be dealt with prior to it becoming a litigation situation. Let's go to the next slide now. So, best practices for successful partnership. Maintain transparency and regular communication. To ensure a successful partnership, establish communication, define roles and responsibilities, and schedule regular financial and performance reviews. So these are things that any entrepreneur should be aware of and should be able to work with their partners in a collaborative way, because collaboration is actually a defining feature of how a business can succeed. Also, set up a structured conflict resolution process to handle any issues that arise. That by this, what we're saying is exactly what I said earlier. We need to consider mediation and arbitration, and if we need to go to litigation, what the process is going to be. If you set up a structure within your agreement to actually indicate that you want mediation or you want arbitration, or if the litigation process is to go forward, then you have to know what steps to make so that the partnership does not get dissolved or does not get into a conflict situation where the partnership starts incurring a lot of expenses while this process is occurring. So these are things and strategies that you need to set up within your agreement, as well as maybe within a internal organization. If there's multiple partners, it's always good to arrange a comprehensive, these are the things we need to look for when we're dealing with issues. So maybe a structure that allows you to have a The word is not coming to my mind right now, but I will get to it in a minute. My apologies. But let's go to the next slide, and I'm pretty sure I will come back to what I was trying to tell you. Exiting a partnership. It's important to have an exit strategy in place. A well-drafted agreement should outline buyout clauses, dissolution procedures, and the financial impact of the partnership. Sorry, my apologies, I'm losing track. And financial impact of a partner's departure. This ensures that the business can continue running smoothly even if one partner decides to leave. So, what I was trying to mention earlier is when you have conflict situations, bylaws are great to give you structure, to allow you to provide a specific requirements within the organization of the partnership. So if you want to create bylaws, those are great ways to actually create a conflict resolution situation and have a third party mediator within those bylaws to be able to mediate any kind of partnership disagreements. Okay. So let's go to the next slide. So these are the main types of statutes that are governing the partnership agreement. Remember how earlier I said, make sure to review these statutes prior to preparing a partnership agreement? The reason why I said that is that partnership agreements have specific statute requirements for individuals who encounter disputes, individuals who encounter the death of a partner, individuals who encounter litigation prospects. So there are many requirements within these statutes that are imposed. If you don't provide in your partnership agreement specific requirements or specific statutes or specific guidelines for saying, okay, this is the exit strategy, the Partnership Act may impose specific requirements and will supersede any contract you prepare. So always refer to these statutes prior to commencing a partnership agreement. This also pertains to the limited liability partnership. This type of partnership is actually governed under the Partnership Act as well, and subject to specific conditions, including professional liability insurance and registration under the Business Names Act. So remember to refer to these statutes because these statutes are going to become relevant in any kind of disputes, or if there are situations where you will have to decide how a partnership should exit a partnership agreement. The statutes recommend specific guidelines, and it's always good to review them. However, also consult with a lawyer because your industry might require other regulatory requirements for you to make sure that you have adhered to every aspect of the required governing statutes. Okay, let's go to the next slide. So last week, I referred to specific cases regarding partnerships. Spire Freeze Limited and Canada 2001 SCC 11 refers to the grounds on which a partnership can be determined. Is one of the essential principles of the issue of this case relates to the existence of a partnership. The three essential ingredients of the valid partnership in Canada, as recently described in Continental Leasing Corp. and Canada 1998 to SCR 298 were if the alleged partners were to carry on a business in common with a view for profit, then they are determined to be partners. However, this is not the only requirement for a partnership. Remember that there's multiple concerns that a partnership can go through. This is where you would want to contact or speak to a lawyer if there are any issues in your partnership. Another case that we referred to that indicates that if a partnership has a proceeding against them, you cannot actually use the partnership's name to pursue the litigation process. In COCOR Construction and Development and Associates and Canada Life Insurance Co. 1998 OJ number 4733 is a case that shows that you would have to bring a lawsuit against each individual partner in order to pursue the partnership, in order to pursue the lawsuit. This is one of the requirements that has been imposed under the common law case that I have provided in COCOR Construction and Development and Associates and Canada Life Assurance Company. As you can say it's a mouthful. The next case in Robert Porter and Son versus Armstrong, 1926, SCJ, the partnership does not arise from an ownership in common. So remember this, a co-venture is different from a partnership. You can have a co-venture or a joint ownership with a property, or you can be doing let's say you buy a taxi cab and you decide I'm going to share the taxi cab and the insurance with another person. They take their earnings, I take my earnings, and however you share the responsibilities. That does not necessarily constitute a partnership. You have to remember that there's a difference between co-venture and a partnership. And in this case, it identifies that the contract is necessary. The contract of becoming a partnership is necessary for the evidence, either by express declaration or by conduct signifying the same thing. It is not sufficient. There should be a community of commonality of interest. There must be a contract for the partnership to exist. That is one of the cases that I wanted to refer to. I also wanted to give you a fun fact about limited liability partnerships. Did you know that Canada was the first jurisdiction to enact limited liability partnership legislation in Ontario in 1998? So we actually helped establish the limited liability partnership, which is a great opportunity for lawyers and accountants and professionals within that field. The last case I'm going to be referring to is Landor General Partnership Limited, RE, 1993. In this, the limited partnership financial exposure is limited to their contribution. So as I indicated in limited partnerships, you have to remember that the limited partnerships contributions are the only thing that could be used for their limited liability. So they cannot be liable beyond that point. The entitlement of the limited partners is limited to their contributions plus any profits thereon after satisfaction of claim of the creditors. This is one of the aspects of the limited partnerships that's beneficial for individuals who are considering to make an investment but not get any further information, any further liability out of the partnership. So next, let's go to the next slide. Role of legal and financial advisors. Remember, all of these discussions that I have, all of this information that I've provided today should be taken on a case-by-case basis. You cannot put every information into the industry that you're within. If you are in a situation where you're not sure of your what industry and how a partnership would impact your industry or your professional entrepreneur abilities, then always consult a legal or financial advisor. They play key roles in ensuring compliance, proper tax planning, and structuring partnership agreements. Having professional guidance can help prevent legal and financial pitfalls down the road. So these are essential risk management strategies to protect the business. Make sure that you protect yourself and the business in the process. And this is why you should always consult a legal or financial advisor. Let's go to the next slide. So summary and recap. To recap, choosing the right partnership type, drafting a strong agreement, understanding tax and liability implications, and setting up proper financial structures are all crucial steps for a successful transition. Make sure that you have reviewed your necessary issues and liabilities before you even enter into an agreement. So always speak to a lawyer or a financial advisor if you think your matter is going to be complicated, if you think your industry has a lot of regulations. Okay? And finally, we are going to the last slide. And I would like to thank you for attending today's webinar. If you have any questions, feel free to reach out. I have provided my contact information on the slide here, where you can contact me, and I will be able to answer questions if necessary, and be able to, even if you would like to discuss further opportunities regarding partnerships, we will be available. And any additional resources are available to help guide I could provide by doing some research if required. However, as a lawyer, I will indicate that it is by client basis, and we will, if you wanted to go into a partnership, we will review the partnership on a client basis once we are retained. Otherwise, we would be happy to answer basic information or even guide you to the right resources. And we thank you for listening to our webinar, and we appreciate your attendance today. We wish you all the best and hope to see you next week. Thank you.